Hello and welcome to Double Entry Bookkeeping, the extended trial balance. This is for my AAT level 3 students, but is also equally applicable to all accountancy students. Feel free to watch. So what we're going to do today, well, we're going to understand why the general ledger is separated in the extended trial balance into different financial statements. I'm going to show how we're going to get there using an adjustment column and a table, and we're also as well going to prepare the extended trial balance. We're then going to close off that trial balance and extended trial balance, and we're going to create the opening trial balance for the next period. What we're going to do as well is I'm going to take you through it in the first half, just what we do, and then in the second half we're going to use the same spreadsheet as we did last time in the last video. That seemed to work incredibly well. A number of students who were taking their exams very quickly afterwards, you could see how their exam scores improved in that particular area of journal production using that spreadsheet. So we're going to use the same thing here in this video and in the future videos as well. It seems to work very well. The link's in the description for where the spreadsheets can be downloaded. So what are we going to produce? Well, we've got this entity and we have this general ledger, and in the last video we were going through that all journals have a positive money and a negative money impact for the company. That creates our debits and credits for our journals. Ultimately, we then post those to our T account. We have the accounting equation, our money in and our money out. Our assets equals our liabilities plus equity, and we eventually end up with a trial balance. And this balances because of the way in which the accounting equation works. Now, this now is called the draft trial balance, and this is all of the accounts that we've got within our general ledger closed down to create a trial balance. Then what we're going to do is we're going to get from this draft trial balance to this final trial balance. You have something called an adjustments column between there, but I'm going to try and demystify that adjustments column a little bit. I think it's a little bit too cluttered within the books, so we're going to split that out, and we'll see what's going on there. And then we're going to take this final trial balance in here, or this draft trial balance plus the adjustments column. We're going to split it into two. We're going to split it into the statement of financial position, which is also known as the balance sheet. This is at a particular point in time. And we're going to have the statement of financial performance, which is also known as profit and loss account, which is a level of performance over a period of time. So, what are we going to produce then? So we've got this period of time going left to right here. We've got two periods of time. Typically they'll be equal. So let's say that this is year 1 and year 2. Could be months, could be quarters, could be what have you. So we've got some periods of time in here. And at these particular points in time, actually at a specific point in time, we're producing trial balances. And so these are statements of financial position at a specific point in time. So trial balance 1 at the start of period time 1. Let's say it's at the start of year 1, let's say. The trial balance number 2 at the end of year 1, which is also the start of year 2. And the trial balance 3 at the end of year 2. And so these individual trial balances here represent statements of financial position. Assets minus liabilities equals equity. So we can see what we've done here. We've taken the accounting equation, assets equals liabilities plus equity. We've taken the minus liabilities and we've put it over on this side. So we've got assets minus liabilities equal equity. And what we've done here is we've given this as what does the shareholders own, here on the one hand. On the other hand, what can the company keep hold of really and have what's almost like headroom against its solvency. So we can have this idea of comparing these assets to liabilities. The company could tell the shareholders, well, we're not giving you your money back right now. So we can have on this one hand, what does the shareholders own? What's their position? But also from the company's point of view, what can it sort of see in terms of its assets minus its liabilities and its solvency position? So that we've got this idea here of a specific point of time. And notice this at here. So this is statement of financial position. The balance sheet is at a specific point in time. Then we've got the other second statement that we're going to have today. We're going to be over periods of time, a statement of financial performance. So how well has this company done over a period of time? So all of this time here being performance over period 1, let's say over year 1. All of this time here, the performance over year 2. And so this is income minus expenses, which is equal to profit or loss. So these are balance sheets at the top, statements of financial position at specific points in time. And these are profit and loss accounts, statements of financial performance over specific points of time. So why are we separating then? Let's just get our first aim out of the way. So we've got two concepts. Why do we do this? Why do we have this separation here? Why don't we just simply give everybody a trial balance and go, there you go, there's the trial balance. Look at balances. We can post some journals. Why do we split it into two? Well, we've got two concepts going on here. On the first hand, we've got something called relevance. We're going to make our information more relevant. So let's say for a shareholder, what does the company own and owe? At a particular point in time, let's say the end of the year, what does this company own? What does it owe in terms of its assets? What does it owe in terms of its liabilities? I, as the shareholder, what have I got left over as the equity? And what's the recent performance? It's a separate thing though. How well has it performed over the last year? And how well do I think it'll perform going forward? Are we making losses? Are we making profits? So what's this sort of idea? So you can see that these are two different things here. This is actually what I've got at a specific point in time, but this is how well this company performs. So we're cutting it because we're answering two different questions. On the one hand, actually, what is the position? How much cash has it got? How much cash did it possibly give to me? And the other one is, how well is it performing? Is this company performing well? Is it performing poorly? To give me an indication of cash or in the future. The other thing though we've got as well is we've got something called comparability. So we can compare recent performance, let's say, to past performance. So sometimes you'll see things like a headline of recent high street sales are 15% lower than last year at Christmas, or something like that. For Christmas including the quarter, and then we see sort of issues, and we can see that the high street at the moment is having problems. We can use our financial statements to compare performance between time periods, both at how our balance sheets have moved, and also as well how our profit and losses accounts have moved one year to the next. So we've got these two concepts going on. Then relevance, we're just making it more relevant. We're answering the questions that a shareholder might have or anybody might have, by producing these individual financial statements. And then we're having this idea of, well, how has this moved over time by comparing one from a financial statement to the next. So that is aim number one. Why do we split our trial balance into two different statements? Well, it gives greater relevance to the information, much better for the reader of the accounts to be able to sort of see, and it also allows comparisons between financial periods. So that's aim one out of the way. Right, so let's go through aim two then. Why have this draft and this final trial balance? Seems a little bit odd, really, to have a trial balance as a draft one to start with, and then a final one next, before we get into cutting it into these two financial statements. Well, I'm going to give you a little sort of picture really of what we're going to do later on in terms of the questions. So I've sort of copied out an extended trial balance here. So we've got our trial balance that we produced in our general ledger. In all of our journals, you'll recognize this from the last video. Then we've got this thing called an adjustments column in here. Now, I've had a look at the books in terms of both Osborne and Kaplan, and this adjustments column seems to be the same in both, so it feels like an AAT thing. Not quite how it would be done in practice, really. It's sort of a little bit more split into two. So I'm going to chop this into two reasons of what goes into this adjustments column, which will make it a lot easier for you to understand. And then we take this trial balance, this draft closing trial balance here, we add on the adjustments, and then we cut it into this profit and loss account and balance sheet here. So why do we have this adjustments column? Why is this just not already in our general ledger? Well, we've got some steps really, and let's have a look at who's producing what. So we're going to cut it into two here first of all. And the first thing that we're going to have in these adjustments in this adjustments column is we're going to have year-end journals. So you've prepared the trial balance using cash accounting. So as invoices came in, you posted them. But if they haven't come in, you haven't posted them. As you paid your money over to various people, we moved the cash around, what have you. The bank statement may not have been fully reconciled at that point. So we prepared our trial balance using cash accounting. We determined what's in there, but it's not necessarily every transaction that's gone on within our period. So we need some year-end journals. So what we've got is, in terms of this adjustment column, is the first section we're going to have a year-end or our period-end journals, let's say in here, and we're going to use these journals, and we're going to apply something called the matching concept, really. Technically, you'll see it within your books as called the accruals concept, but it's much easier to understand as the matching concept. That what we're going to do is we're going to match income to particular years, particular periods, and we're going to match expenses to that income. This makes company accounts comparable and true and fair. And we're going to do that very much in the next video, so don't worry about needing to understand that right now. I'm not going to throw all of these concepts in at once, otherwise this video will be 5 hours long. So, first section we've got in this adjustments column is we're going to apply some journals at the end of our period, and these are journals that are required in order to apply this particular concept, the matching concept, technically called the accruals concept in here, and that will make our accounts true and fair and comparable to other accounts, and also it will make them more reflective of reality. So the adjustments column really is more, first of all, what you would see is the year-end journals column for the preparer of the trial balance. So it will be one person who's taken their draft trial balance. They then prepare the year-end or the period-end journals. Might do this monthly, might do this year-end. Typically, you tend to do this year-end, and they will prepare a series of journals. They will put them in this column, in the adjustments column here. So what this will really look like normally is this would be called year-end journals. The journals will be put into this column here, and then we'd agree it. So let's say the preparer of my accounts, I would sit down and have a discussion with them. I would have a look at what was the reasons why they've produced those journals, and then we'd agree them, and then they'd be posted in the journal, the book of prime entry, that's called the journal in that. We'd agree them, and then we would produce our final trial balance. So that would typically be what we would see in one step of this adjustments column. Now the second one would be from another person. So somebody else has now come in and they've taken this final trial balance that's been produced with these period end journals, and they would have a review of it, and they would sort of compare it. So there's one person's prepared the draft trial balance. They've also as well, actually that then becomes a new draft trial balance. Then they're going to be checked by another person. Might be an external auditor, and they may find errors. And so they'll put the errors, if I go back, they'll put the errors into here as well. And then that will then move us from this trial balance that would have the year-end journals in to correction for the errors, and then we would get to a new set of profit and loss account and balance sheet. Now what we always want to know is, in this sort of conversation, is, well, what's the impact of these errors? And here's typical questions. So it's usually quite an easy method or an effective method to be able to sort of have this adjustments column sort of sitting in there, and the impact on the profit and loss and the balance sheet. So it just makes it much easier to sort of see what's going on by having that additional column and not having it hidden away within the trial balance. They then again have to be agreed before they're posted to the general ledger. So what we've got really here going on in this adjustments column in here is two things. On the one hand, period end journals, and that will typically be produced by the preparer of the accounts. On the other hand, correction for errors, possibly done by the preparer of the accounts, but I think they would have just corrected the errors, but typically by somebody who's doing an external review. Hopefully that makes this adjustment column seem a lot more sensible, that actually it's not adjustments, it is two sections. One is period end journals and the other one is finding of errors. And what I'm going to do as well then within this video is I'm only going to do period end errors. I'm going to do errors in the adjustments column for this video, and then I'm going to take you through the period end journals in individual videos over the next sort of series of accounts. Much easier, much more straightforward to be able to see what's going on. So aim number 2 then, we've understand the adjustments column. Well, yeah, we've actually got two sets of adjustments going on. On the one hand, they're period end journals that we're going to have, and what they're going to do is they're going to make our accounts look true and fair. They're going to apply this matching concept. I'm going to take you through that in the next video so we don't get too cluttered in this one. And also as well, they're going to be where somebody else has come in and they found errors in the trial balance, and they're going to put those journals in there. We're going to see what the impact is. Now what we're going to do is we're going to go in and we're going to start producing some of these extended trial balances using the spreadsheet. Right, so what we're going to do then here is we've now got our spreadsheet open, It's an adjusted version of the one that we used in the last video, and what we're going to have here is we've got 9 journals which we're going to post normally to the general ledger and produce our draft trial balance. There's our opening trial balance there, though. We'll produce our draft trial balance here. Then we've got an adjustments column, and in this set of questions here, we're just going to have errors of omission, and they're going to be the last journal at the bottom. I'm not going to do the other errors or the period end journals in this video. I'm going to do those in individual videos as we're going along. So I'd rather sort of not clutter this up at the moment. In this video, what we're going to do is we're going to learn the structure. We're going to take our closing draft balance, put in our adjustments, which in this case is going to be our adjustments for errors, and we're going to cut that into our profit and loss account and into our balance sheet. And then also as well, then we're going to close down this year, and we'll create our opening balance sheet for next year. So we'll do all of that. And in the first thing then, though, as you normally know, we go along here and we just produce this. What I'm going to do as well in this one is I've given you 25. I've given you 12 questions. I don't think you'll need that many, and also as well, you'll be doing a lot of this in the next sort of sets of videos. So don't feel the need to go through and do too many of these. Sort of one or two of them, because you're going to see a lot of repetition. So what we've done then is we've put our journals in now, our front 9 journals in here, and we're going to go through and produce our opening balance sheet. So we've got our opening trial balance here. The question is usually going to say convert that into a balance sheet, so let's just produce that there. Let's produce these ones in here. So as you'll see, if you are new to this particular video, I would encourage you to go back and read or watch the previous one, just to get the idea of how this spreadsheet really works. What you'll see is if you put the right numbers in the right places, then it turns green for you. And let's just make this one wrong. Let's make that credit or a debit, and you'll see it turns red as well. So it can really sort of much faster way of producing or checking your work. So we've got our opening trial balance here, and let's put that into here. And then we're going to put our journals in as well, produce our trial balance, our opening draft trial balance, and then we'll get on with the extended trial balance. And if by magic our journals have now dropped in, so I've dropped in this opening trial balance into our T accounts. I've taken these journals, I've put them in our T accounts, and then turned that into a balance sheet over here. What we've now got then is down here, this last journal here, which we didn't post really. This is an error of omission. So we're now going to create this one. So what we got? We got customer pays a debt of 1969 by back. So that's my bank, and that's our positive money item. So our money item goes up. Positive money item, which is debit 9169, and we've got our debtors, and that's a money item that's going to go item that's going to go down. So that's a negative money, and so that's a credit. So that's 9169. Okay, so we posted that. That's our journal that we're going to put in. So we now need to put that into our adjustments column. So we put our bank into there and our debtors into our adjustment column there. So we've got our 2 items. Now what we're going to do then is we're going to add that to these here, and then cut it into our balance sheet and our profit and loss account. And what I'm going to show you first of all is how we're going to do this. So we're going to really sort of convert these. You could do this in the individual accounts if you wanted to, or alternatively we're just going to work out, and we're going to see how this looks with a set of numbers. So let's see. So in terms of positive money, in terms of our debits, so positive minus our credits, that's going to give us a figure here. So you can see these are positives here, and our credits are negatives here. And if we total that all up, it would come back to 0 there. So we've got our positive figures here and our negative figures here, a bit like the way we explained it in the last video on the number line. What we're going to do is we're going to add these figures onto here. So we're going to add that on. That's going to be a minus, that's going to be a plus. So what we would end up with then, if we just clear this out of the way, would be negative positives, and then we've taken that figure off that to get our debit there. And we've added that figure onto there to get our debit there. Let's keep going, and then we're going to fill in the rest of our balance sheet and the creditors as well. And then we've got shareholder capital here. Ooh. And those are our balance sheet items. So things that are at particular points in time. So these are our buildings and our cars. These are cash. These are our assets. These are our liabilities. So these are our money in items. These are our money out items. But you see this doesn't balance in here. So how are we going to get this to balance in here? Well, we've got this thing called this profit and loss account in here. And what we're going to do is we're going to create a separate account. I'm going to put it down here. And we're going to right. So this is going to be the profit and loss account in our general ledger. And what we're going to do is we're going to put all of our sales in here first of all. So we've got our sales and our purchases and our rent and our telephone. So these are our profit and loss account out items here. Okay. And what we're going to do then is we're going to then convert and we're going to post from these ones. So we're going to go debit our sales, 24,000, because we're going to convert these items now back to 0. I'm going to go credit this profit and loss account 24,000, and we're going to go debit our purchases, credit our purchases 9130, and we're going to debit our profit and loss account 9130, and we're going to credit our rent 1100, and we're going to debit our P&L account, and then we're going to credit our rent, our telephone 100. So what we can see here is in these accounts in the general ledger, these ones here, which is our profit and loss accounts, if I just highlight these in a different colour in here, these ones in here, these were all of our balance sheet ones here. That one, that blue, let's say. These were our balance sheet ones. These were either assets or liabilities, or assets, liabilities, or our shareholder capital. These ones weren't. These were all of our movements in shareholder capital that over time. So these are our profit and loss account figures in here. We're going to balance all these down because in the next period we want to start off with an opening balance and all of these are being 0 because we want that for the next period. Here then, so what we're going to do is we're going to transfer all of these figures. So we're going to debit sales, credit P&L account, credit purchases, debit P&L account, credit rent, debit P&L account, credit telephone, debit P&L account. So what we've done is we've converted these both onto 0, and we've then got this P&L account here. Okay, and that is going to be equal to all of these minus all of those. So that's a P&L account here. And what we can see here is that so our carried down on our P&L account is this when we balance it off. That's our carried down. And balance our account, which is going to balance 24,000 there. And so our brought down, well, I'll just put our brought down is going to be that figure there. So that's our actual balance within the balance sheet. And you see how we've got this account that's in the general ledger now, this P&L account in here, and that one is credit 13670. And so we've cleared all of these ones out here. We posted them to the P&L account because we cleared out all of these accounts. We wanted to keep these ones going over time into the next period, but these ones we don't want to be going into the next period, so we clear them out. We put them into this P&L account in here, and it appears here. Now, actually how this then works in reality is that these are known as distributable reserves, so it might be kept separate there, but what I'm going to then do is I'm going to just combine these two together to give the total shareholder capital figure. So what we've done then here is we've taken our trial balance in here, we've put some adjustments in there, we've then converted it into these two sheets in here, we've closed down the profit and loss account for the year, and we've transferred all of these accounts in here. We've cleared them all down to 0, and we've transferred this amount into this profit and loss account in here, which we put into this balance sheet. Then into the next period, what we're going to do then is we're going to have our opening balance. We're going to just transfer all these over because these are all our brought down balances here, and we're going to have our AAT and our creditors, and then we're going to just simply add our profit and loss account into our shareholder capital here. So that is then a new shareholder capital for the next period. That's if we're doing it like this. If we're doing it in reality, in a set of financial statements, this actually might be slightly different. This might be shareholder capital, and then this might be reserves, and we'll call them distributable reserves. Ooh. Let's say this company was started with £1,000 worth of shareholder capital here, and that was the shares that they put in, and over time it's made £158,000 worth of profit. That's how it would probably look within the account, something along those lines, because this couldn't be sent back to the shareholders in terms of dividends unless we did something, a legal thing, and this could be. But for the purposes of this level, we don't really need to do that. So what we've done then, we've taken our journals, which we know how to do in our previous video, and together with our opening balance sheet, we've produced our general ledger over here. Put those, which are all these items, put those into this opening draft trial balance. We've then put this error journal. We put that into here, and then we've cut that then into our balance sheet and our profit and loss account. We've closed down all of these profit and loss accounts within the general ledger for the year. We turn them all back to 0, so they're all starting at 0 in the next period. And the way in which we've done that is we've transferred this into the profit and loss account into here. And when we do that, we can see then that our balance sheet then balances. And then we've then gone and flipped that into the next year. So that is the extended trial balance. What we'll then do in the next series of videos is we'll go through the period end adjustments in here. These are all still adjustments there though, but we'll do things like accounting for inventories, accruals, prepayments, deferred income, accrued income, etc. We'll do all those in the next ones. Thanks for listening. Bye bye.